Hi guys, so just going to bring in my colleague here, David Stevenson, who will be conducting the next one-on-one interview with SocGen's Andy Lapthorne.
Thanks,
Over
Tom.
to you, David.
I'm assuming everybody can hear me okay, because with these things you never really know. Thanks, Tom, for introducing me. I'm now going to bring in my colleague, Andrew Lapthorne. I've known Andy for many years. Hello, Andy. How are you?
I'm good. Checking you can hear me.
Yeah, I can hear you loud and clear. Excellent headpiece there. Much better than what I.
It's missing one on this side. It just feels wonky for me. But
okay, so Annie and I talked many times over the years, and we regularly talk about factors and smart beta and all sorts of stuff. So what we're going to talk a bit about today is we're going to range from kind of general market discussions, particularly about the concentration effect that we've seen in the recent stock market rally after the COVID sell-off. And then we're going to sort of range all the way through to looking a bit at some of the issues that Andy looks a lot at, which is around the issue of debt and balance sheet risk, and how we can quantify that and what that's currently telling us. A subject which is quite close to his heart, my heart, and I'm sure many of our viewers' heart, which is inflation risk. Is there any inflation risk? We'll talk a bit about that. We'll talk a bit about machine learning. Andy's been involved in an interesting project looking at machine learning and factor investing. I'm sure quite a lot of our viewers, if we want to pick up some questions on that. And also we will touch on everybody's favorite subject, which is ESG investing. Is it a factor? Is it not a factor? I'm sure we'll pick up on that many times over the next few hours. But I want to kick off first, Andy. It's been an odd market rally, hasn't it? It's been very concentrated. I mean, it comes no revelation to anybody watching this seminar that, you know, the FANGs have done very well. It's been a very concentrated effect in a small number of large mega cap American growth tech stocks in America. Is this usual? Is it really as pronounced as we all think it has been? Is it very concentrated in a small number of stocks?
Yeah, I mean, we all know it is. I mean, I'd add that it's not just for US, it's also emerging markets. There's some very big companies over there which has been doing phenomenally well. As Bruno was saying earlier, you know, this concentration risk is leading to significant problems, not just for factor investors, for all investors. Because if the choice is ultimately that you live or die by owning just 5 stocks, then you have to own those 5 stocks. I've reported that, you know, in terms of tracking error, the tracking error of not owning those 5 stocks in the S&P 500 is about 500 basis points, which is huge. We have seen this before, though. We saw this at the top of the tech bubble. We saw a similar phenomena, so it's not unprecedented. And I would also add that it's not just those 5 stocks which are doing really, really well. You know, Bruno mentioned momentum had been doing really well. Growth stocks have been doing really, really well. What is unusual this time around is just the sheer size of those businesses. And normally at the top of the index, you might see a very big bank or a very big tech company or a very big oil company. But actually, you've got 5 companies which are predominantly doing a similar thing. So they're highly correlated, and they happen to have, you know, they happen to be growth stocks, and, you know, they happen to be doing rather well. So it's a lack of diversification, their size, coupled with the fact that you've got a typical end of cycle type growth, you know, dynamic going on, which is not unusual, to be fair.
You mentioned some of the factors that have been doing well. Momentum's been doing well. Growth's been doing well. Value's not been doing well. Again, I'm sure we'll talk about this over many other sessions. I mean, a lot of people have been willingly writing the obituary for value. I mean, value, you write a lot about value, and value is basically underperformed. God, when should we pick our point when it's undervalued underperformed for a long time? It doesn't look like it's getting any better. I mean, are we going to have mean reversion? Is value going to come back in? What are the catalysts?
A better question is, do we think value has behaved unusually to how you would expect value to perform? Now, the economic cycle peaked at the beginning of 2018. Most value strategies peaked at the beginning of 18, and obviously since then we've had a series of you know, pretty aggressive moves by the Fed at the end of 2018, and obviously we've had the COVID-19 problem as well. You know, there is a long list of things which is wrong with value. You know, everything from, you know, more immediately COVID, You've got the balance sheet risk there. You've got the size issue. Equal weight has underperformed market cap weight pretty much for 10 years.
Yeah.
Now, equal weight outperformed market cap weight for probably the previous 40 years.
Yeah.
So if you think that the very nature of a stock model or a quant model is to pick an individual stock and to find a good individual stock, but the average stock is underperforming the index, then of course your model is just going to fail, or it's going to be very challenging, because essentially the average stock is not doing very well. In fact, the underperformance is of equal weight versus market cap weight is sizable. There's another thing to think about in terms of the value debate is world ex-US versus the world. The US has been driving the market for the last 10 years. Quite remarkably, I was looking it up while Bruno was speaking. The underperformance of world ex-US to MSCI World over the last 10 years is about 500 basis points per annum.
Got that big?
Per annum. It's huge. Now, if you were to measure a value index or a value strategy versus MSCI World ex-US, it's not doing so bad. In fact, it's up until the beginning of 2018, it was kind of there or bounce, tracking the model, tracking the market. So you've had a cyclical downturn, and you've had a huge dominance of US stocks versus the rest over the last 10 years. And then, of course, you've got quantitative easing. Now, quantitative easing has literally split the market in two. And the best way to describe this is how you treat a discounted cash flow model. So say you've got a consumer staple stock, not very cyclical. Share price goes up, the bond yield comes down. You put that lower bond yield into your discounted cash flow, you get a higher share price.
Yeah.
So therefore, you would happily re-rate quality stocks, low vol stocks, growth stocks on the back of low bond yields. If the bond yield goes lower, are you going to input a lower discount rate on your mining company or your bank? No, of course not, because they're more cyclical. Now, one of the things which is absolutely unusual about this cycle is effectively stocks were not that sensitive to bonds, i.e., if a bond price moved, it didn't really differentiate or determine your valuation. But now if you were to take, say, a portfolio of the most correlated to bonds, MSCI World, they're trading on a price to book of 4 times versus 2. And the inverse of that, the cyclical group, is trading on a price to book of 1. So let's not underestimate the kind of market we've had. We've had a market which has been driven not by fundamentals, it's been driven by QE, and it's been driven by the revaluation of stocks that people think are not particularly cyclical. And it kind of echoes what we had 20 years ago, i.e. everything is cyclical, ultimately.
I just want to go back. There is a kind of a second kind of argument going around, which is that some of the risk premia that were identified aren't really real once you actually test them out and test them to destruction. You and I probably saw this morning, John Authors over at Bloomberg did a nice piece picking up on Cliff Asmus's research and David Blitz's research, which is that small cap premium may never really have existed in the first place. Again, the small cap, it's already been hinted at by your point about equal weight, because equal weight has a stronger small cap kind of element to it overall. Did some of these factors never exist in the first place? Did the small cap premium never really exist in the first place? We're pretty sure value did, and we know some of the other factors definitely did because they've been exhibiting outperformance. But did some of the factors just never exist? Are they effectively a kind of a fragment of our imagination, and we've tortured the numbers so much that we came out with the results we wanted to?
I remember being on a panel, I think, with a very well-respected Cambridge professor, and he said it's amazing how people still write about the size effect because it's never really existed at all. I think there is I tweeted Cliff saying actually the harder question is equal weight versus market cap weight. That's the harder one to answer. Yeah. I totally agree with the conclusions. In fact, the AQR paper, Size X Junk, is a very good one. Yeah. We incorporate those ideas into a lot of our work. If you think about it, if you're a bad company, you eventually fall out of the S&P 500, and maybe you go into the Russell 1000, and then you go into the Russell 2000. Once you're there, you're kind of stuck, and therefore quality matters far more in the smaller cap space because you don't have the survivorship bias that you have in the large cap universe. So it's vitally important when you're looking at small caps to clean up for these zombies, to clean up for bad balance sheets. And once you do start cleaning up for those bad balance sheets, you do find really interesting alpha. But that's not to say the whole small cap space has alpha. It's just a really good hunting ground for alpha because you've got this nasty quality element to it. And as you know, we've been specifically targeting the Russell 2000 using that thematic, not systematically over 20 years, but simply because the state of affairs which have developed over the last 5 or 6 years with QE and leverage in the US.
I also just one again tangential question. I suppose it's really a function here of what George Soros used to call the kind of reflexivity argument, and I suppose Andrew Lowe's also called adaptive markets. Has the growth of value indices and value screens and values ETFs and the whole growth of value, has that had any impact? I mean, you would presume, arguably, that actually the growth of the development of of these indices and ETFs would have increased the demand for the value stocks, and we might see thus the premium. In fact, the reverse has happened. Do we have any sense in which, just very briefly, that the existence of all of these value-orientated ETFs, lesser than they used to be, I might point out, might have had some impact?
Look, I remember when I started out, when I wanted to do a model, I used to have to go upstairs to the library, get the report and accounts, and start typing in numbers. Yeah. So, the Ben Graham notion of going through report and accounts, looking for that odd gem, stock picking value, I think still exists.
Yeah,
it's a long way from systematic factor investing. And you've heard this explanation lots and lots. For me, a value portfolio is a portfolio of problems. Yeah. You're buying the cheapest stocks in the market. So by their very nature, they must have a problem. So if you think about it, in 2018, we were buying cyclical problems. You might be buying banks because you've got an interest rate curve problem. You might be buying old autos because of Tesla problem. You might be buying oil and gas because of ESG problems. So essentially your value portfolio is basically a whole portfolio of problems. Now, I think we could all agree that we've got a lot of problems. And that those problems are reflected in very cheap valuations within the value space. For you then to make money out of value, you need to start getting rid of those problems. Now, we do temporarily get rid of them. You might see a spike in the oil price. You might see a sudden inflection point in the yield curve. And for a moment, value rallies really, really hard. And then you find out that actually it was just a temporary blip. We don't have sustained economic growth. We don't have above trend growth. We're back onto the QE story. So for me, you have value in your portfolio because you think those problems are discounted. And obviously, if you were to build a portfolio just of problems, I suggest you wouldn't sleep much at night. Yeah. But we've seen it over the years where you suddenly get some noise about interest rates, some noise about, I don't know, a COVID-19 vaccine, and all of a sudden value stocks are exploding upwards. So I don't, if anything, I think there's less and less people doing value and more people doing quality and min-vol. And that's reflected in the fact that quality stocks and min-vol stocks are often trading at 4 times the valuation of value stocks. So obviously diversification is important, but if you've got something which has fallen an awful lot and is suppressed by macro, and those macro changes, then you'll make money. But obviously you don't want a portfolio of the same macro risk either.
Just want to focus on 2 risks, which are worth, you've already mentioned one of them, and I suppose you're inferring the other. Balance sheet risk. There is a lot of balance sheet risk out there. QE's done a damn good job of sort of massaging it and making it look a bit better, but it has a funny old habit of coming back. Let's talk a bit about balance sheet risk and inflation risk. Again, you sort of implied it. We have a COVID vaccine, markets move up again. A lot of people are worrying about not inflation tomorrow, not next month, not even next year, but maybe 2022, 2023. Any sense in which the markets and particularly quant investors are underestimating the inflation risk? So inflation risk, balance sheet risk.
Let's start with balance sheet risk first, and anybody who's ever come across my research will have suffered me talking about this for forever. I'm a big user of Merton's distance to default. I'm a big user of the combination of volatility and leverage to measure future risk. And I think Bruno mentioned it in his talk about correlation and the fact that low vol maybe didn't do as well as it should have, because effectively low volatility stocks were just looking in the rearview mirror at their price performance and not thinking about the consequences of having too much debt on their balance sheet if we go into a crisis. So things like a quality strategy, which had balance sheet risk at its heart, on a long short kind of beta adjusted basis, massively outperformed min vol in this crisis. Now, this is a multi-generational problem. It started in 2013 when we saw a huge increase in debt for several years. And now everybody knows that we've got peak leverage.
Yep.
At a point where we've got record low levels of interest rates, and also you've got earnings under pressure. So there is a big reason why the Fed rode to the rescue of credit markets very, very quickly in March, because it really had no choice.
Yep.
So balance sheet repair, avoiding balance sheet risk, predicting balance sheet risk before it actually appears in the share price is pivotal in a defensive strategy, and that's something that we look at a lot. I wrote about inflation recently. It was the classic research document where you think I'm going to write this in 24 months and 24 hours, and it takes 3 months to write. Very, very difficult. We asked the machine learning system to ask us what to do with inflation, and it basically said, I have absolutely no idea because I haven't seen it.
Yeah.
Which, they're very good on machine learning system. They don't moan too much. You just give them a task, they do it. We've only seen inflation shocks. We've only seen, food, energy, mining related shocks, where essentially you get an imbalance between supply and demand. That creates a price shock, which leads to an increase in, say, break-even inflation expectations. And because it tends to be a temporary supply and demand shock, it is then resolved, say, on a 12-month to 24-month basis. But we can't model, say, 4 or 5% inflation because we haven't really seen it. But certainly, if I give you the opportunity of buying a 4 or 5% bond yield, David, would you buy it today? I'm guessing you'd probably sell some stocks to buy to put it into bonds. So you could see what elevated inflation will do if it is accompanied with a higher yield curve, steeper yield curve and higher rates. The quandary is if it's not. If all of a sudden central banks don't do anything with the interest rate, and you do get genuinely higher inflation, 300 basis points would do. Even 200 basis points would do a lot of damage.
And I read the paper, and what was interesting, I think at the end of it, you came to the conclusion. I read so many research papers. It may not have been you, actually. I may have conflated it with someone else. But I think you basically suggested that you basically go and pick a bunch of mining stocks and a few fertilizer companies.
Yeah, no, that was exactly it. It was.
Okay, I mean, and what that practically points out to investors is, I want to sort of immunize against inflation risk, but do I really want to buy a bunch of mining stocks and I don't know, potash companies?
The key when you're thinking about risk is, why are you worried about it? Are you really worried that we're going to get sustained inflation? No, because we haven't really explained that. The deflationary forces are very much in place.
Yeah.
Are you worried about inflation because interest rates are zero and you've already got massively negative real yields? Well, even 50 basis points is going to hurt you.
Yeah.
So real wealth. So you're not really worried about inflation. You're worried about inflation and its potential impacts on asset markets, which have gone higher and higher on the basis of low interest rates.
In which case, I suppose what you might do at that point very quickly is invest in gold.
Well, funnily enough, we put 20% gold in the strategy as a choice. But you'd also own it against quality equity. You would own some quality equity. I'm not saying put all your money into food, fertilizers, and mining stocks. But again, those type of businesses are sufficiently cheap, maybe to warrant being in a multi-asset, multi-factor portfolio. In fact, when you start to think about value, you start to think about how you could cut value into different risks. I don't want balance sheet risk. I'm quite happy to buy cheap cyclical risk. I might want to buy a cheap inflation hedge. So I think you could take all your individual factors and slice them, especially the value universe, into different risks. And say you've got bond yields in your portfolio and an inflation risk basket. Well, they're quite good bedfellows. You know, they'll provide diversification.
One quick question. Got a good question here from the floor. Once one can see some clarity on the global rebound in the economies, do you anticipate that the value factor will take on momentum-like characteristics and outperform as materially as momentum has over the past few years? That's an interesting question. Will effectively value become the new momentum, or could it?
Value is more like a call option on good news. So essentially, like any option, you buy it in the hope that the good news will appear. But buying value once you've seen the good news is a kindless, pointless exercise. And again, I've done the recoiled spring argument so many times. Is you take your value portfolio, you get Brexit, you put in house builders, you put in banks, your PE is going lower and lower and lower and lower. And then all of a sudden you get an agreement on Brexit or whatever, and it moves 10% in a day. Yeah. Now, what we did an analysis and found out that 90% of returns to value are concentrated in those inflection points, which is why value investors are so miserable, because essentially you wait 2 years for the performance. It happens all in 5 days. And then you spend the next 2 years waiting for the next problem to be resolved. So the reason why you combine value with momentum is to counter that point. Now, the problem that value momentum have had over the last couple of years is there's been zero overlap between the value momentum universe. You're either a bond proxy or you're a cyclical risk, and therefore you didn't get that diversification happening. So yes, you do get phases of momentum, but you know, value momentum as a combination hasn't been so great.
And it's very time limited, you say. It's a sudden snapback. Yeah. You mentioned machine learning earlier on. I've written I think I've written a column with FTFM about this. But you've been having a machine learning program running for a while, and I did smile when your machine learning program turned around and said absolutely no idea on inflation. Obviously, you've taught your machine learning program to be honest, which is very impressive. You're probably more than a year into that program in terms now, more than that, aren't you? Where you've actually had real money behind it. What are the big learning points from that machine learning program that you want to share with the audience? Are there any?
Huge. I mean, huge. I mean, a couple of points about machine learning. It is data mining. It is absolutely data mining. Yeah. I asked an audience at a conference how many of them did data mining, and only one person stuck their hand up, which was George, my colleague, who built the machine learning model. We all do data mining. And as human beings, we're rather poor at it because we have forward bias. We know history. When you ask a machine to look at history and to predict what's going to happen over the next month, it's not going to predict, it's not going to view what happened 2 years later and then come back. So actually back testing using the machine learning systems is far more robust than many of the processes. Now, many years ago, using the factor zoo, I said to George, have you ever used machine learning before? He said, no. I said, would you mind going off and building a machine learning based factor investment system for us? So he went off and did it. Now he's an expert in factor data. Another point about machine learning, if you feed a machine with bad data, it will get really, really bad answers. You know, if you give it a bit of forward looking data, it will embrace that data because it could see the future using that data, and returns will go to the moon. But obviously there's a lot of hype about machine learning. So we were looking at these returns and we were also looking how difficult it was going to put those returns into practice in terms of turnover and trading. So we went to SocGen and said, can we put this into practice? Can we see if it actually works? Now, we put it into practice at the beginning of 2019. It uses all the standard factors that people use, you know, value, momentum. It's changing them dynamically. And look, it hasn't shot the lights out, but since we went live, it's basically flat. It's made a little bit of money with very little volatility. So if we would compare it versus the factors that we were using, obviously it's outperformed. So it tells you that one, there is information in factors, but how you put those factors together is of paramount importance.
Yeah.
I would also add that a lot of the factors are almost inaccessible because of their difficulty to trade. You have to trade fast and far faster than, say, an index rule would normally allow you to do. And you can't run billions on the back of this type of stuff because turnover would just erode those costs. So I love machine learning, but you have to embrace it for what it is. It's an amazing data analysis toolkit, and we've been very impressed with the results.
But you're saying there, though, that capacity-wise, it's not a strategy. You're really talking about low hundreds of millions as opposed to many tens of billions. It just can't work at scale.
Yeah, but again, you could start using it for other things. So you could say if a machine is saying, we should probably start losing a little bit more value here, or it's saying maybe we're probably going to load up a bit more on reversals, you could start to get the machine
What you're saying is you could use machine learning not as effectively an alpha seeking strategy, but actually as a kind of second voice,
exactly.
That person in the corner of the room who always wants to put their hand up and disagree. You could use it as the kind of the testing out mechanism of your overall consensus strategy. Yeah,
indeed. In fact, what we found out is the machine learning system is far better at making decisions than we are. So,
that's it. All out of a job. One last question from the floor here, just going back to strategies in our slightly peculiar QE dominated world. Intuitively, would inflation plus dovish central banks mean you want to go long value, low quality, i.e. zombies, because we inflate away balance sheet leverage? It's actually a good question, because I was sort of kicking around in the back of my mind is your point about balance sheet risk is taken, but let's be honest, as you yourself have said, you've been going on about balance sheet risk for a while, and it's been getting bigger and bigger. And if I had £1 for every time somebody said we've got to peak leverage, and then we get even more peak leverage, would that strategy that one of our viewers suggested probably possibly work?
I would frame it. I would not buy leverage, because you're at the point of maximum generosity in terms of leverage. You've got record low interest rates. You've got very high asset prices. You've got central banks doing their very, very best to keep markets from really going down to the extent that the Fed is buying high yield debt. So everything that could be good in terms of environment, financial conditions for stocks with bad balance sheets is very, very good. But obviously the earnings and the interest cover is not very good. So it's going to take a long time to generate proper sustained inflation. If you get a change in interest rate expectations, this stuff will hurt. And as you know, from my perspective, balance sheet risk has been the key factor in making money throughout this year. It's a subset of volatility, and the strategy that we implement has been very, very good, not only in down markets but also trending up in normal markets.
One last 50-second question. I can't resist the ESG question, Andy. Is ESG a factor, and can it permanently outperform?
We've created a pure factor ESG index, which removes all the biases, all the unintended bets, factor bets, sector bets, and it's up 200 basis points versus the benchmark in Europe this year. Now, it wasn't previously. So there does seem to be this year a drive towards ESG, which was not there before. The problem with ESG, and MIT made this in an excellent paper they wrote, we can't measure the performance of something which isn't being measured properly. If one index provider is saying this company is great and this company is rubbish, well, if they're all differing in terms of opinions, how can we measure its performance? We don't know what we're measuring. But clearly the appetite for ESG is there. I do think it needs to be considered within the context of the valuation that you're paying for it. A key question in the future will be, how much money are you willing to risk for that good ESG company versus that bad ESG money? Because it's not just about their profits, it's about the valuation. But ESG is here to stay, and I really hope we start to get some clarity on the data, because I need data.
Okay, on that point, Andy, thank you very much. We've come to the end of our allotted time. Thank you very much, Andrew. I'm going to hand back now to Tom, and we'll move on. Thanks very much, Andy. Bye, Tom.